Togo Hjortøy, we have seen a lot of remarkable events in first quarter in the world in first quarter 2011. Which of these events have you been looking at in the high yield value bonds team?
Well, we have certainly followed the earthquakes in Japan and the uncertainty for the people over there. But more importantly for us and our fund, the crisis in Middle East and the impact on oil price has been of great importance for our funds. Given the fact that we have around 32% of our fund exposed to energy, and it seems that the oil price are expecting to be above $100 per barrel in the rest of 2011, which certainly has a positive impact on our portfolio.
We also saw a new chapter of the sovereign debt crisis in Europe. How does that affect your fund?
Well, you could say that this has been an ongoing theme the last couple of years. And I actually expect it to continue also the rest of 2011. But of course, it always makes the market more volatile once the headlines is biggest of this theme. However, you can say that during the first quarter of 2011, our asset class, as well as our fund, has actually performed very well. And it seems that the asset class is robust for the uncertainty in that area.
Yeah, and how was the performance actually in the first quarter?
Well, we continued our good performance from 2009 and 10. And this quarter, we ended the quarter with a return of 6.25% relative to the benchmark of 4.02%. So we are actually, if you look back in 5 years, we are top 3 in Europe among high yield bond funds.
Your fund is exposed to the financial sector. Do you see any general trends within this sector?
The crisis in the financial sector in 2008 have involved that the regulation in this sector is becoming more restrictive. And one of the ways that this is introduced is definitely in the favor of creditors. They're selling off assets, they're reducing debt, and they are issuing new equity. All three initiatives that are making the banks more robust, being in compliance with the new regulation. Among those are Basel III, and it definitely also makes our investments more attractive also going forward.
You mentioned that it makes the banks and the financial sector more robust, but does it also give you an opportunity in the short run?
One of the ways that the financials are reducing debt is by buying back existing bonds. And of course, the investors are gaining from that if one of our bonds are being bought back at higher prices than the current market price.
You mentioned that the fund has an exposure to the energy sector by 32%. How does an increased oil price affect investors?
The crisis in Middle East has pushed up the oil price to more than $100 per barrel. And on top of that, the nuclear power plant uncertainty and how that's going to be an impact in the energy and oil prices in the future is also something that's going to go on for the rest of this year at least. It definitely makes us comfort that the oil price will continue to be at attractive levels. In our fund, we have been focusing on buying corporate bonds with pledge on assets, such as oil rigs and oil fields. And it definitely makes the assets more valuable once the oil price is increasing as it has this quarter. So you can say higher valuable assets in our companies definitely also makes us more comfort in our investments. And we also think that the oil price is not priced in the current prices of our corporate bonds. So we think that there are room for credit spread narrowing and high returns from that exposure.
Have you found new and interesting investments in first quarter?
Spar Invest value bonds have been very involved in the Nordic energy sector for a number of years. And we have gained a good reputation also to the companies, and meaning that when the company needs to renegotiate or issue new debt or refinance existing debt, they come to us directly, and we are directly involved in renegotiating the new debt and putting some word on where we would like to see the coupon, how restrictive we would like to see the covenants. All in all, basically a risk and reward balance for us as investors, and also what's actually fair for the company. And one of the companies that we have been involved in is PA Resources. PA Resources was and has been a bond that we have been owning for a number of years, and the bonds were to mature the next couple of years. So the company came to us and renegotiated a new bond, which we have bought into and sold our existing or the old bonds. And it ended up with a very attractive coupon of 12.25%, which we certainly think that our investors will gain from the coming years.
How can a company like PA Resources benefit from the cooperation with Spar Invest?
Well, they of course are also interested in having long-term investors in their corporate debt. And we have shown a number of companies in the Nordic energy sector that we are committed owners, and we stick to the companies that we like. And that, of course, also makes the company more comfort in issuing new debt.
Important issues or themes within high-yield value bonds is the M&A activity, but also the default rate. How has it been in first quarter?
Well, you can start to look back and say that the M&A activity has been very low the last couple of years. But part of that story has been the focus from the companies to delever their balance sheets, gaining profitability, and etc. And in that way, they have not been focusing on growing their company. But as of today, the cash in the balance sheet among the large companies are growing, and it is at the size where I think that we will begin to see more M&A activity. And when it comes to M&A activity, it is something that we, as part of our value bond process, is trying to gain from, namely by focusing on small companies with solid balance sheets and valuable assets, all three factors that are a very highly likely M&A prospect. In other words, you as an investor can gain from that a small company is bought by a larger company, and it can give a positive return from our holdings.
And what about the default rate? Is that influenced by the events happening around the world?
Our default model is predicting historical low default rates. And if you look at the bonds, which is priced at the level as it is today, we think there are room for credit spread narrowing and room for more return for our investors.
Which are the most important lessons we can take from first quarter 2011, and how does the future look?
Well, you can say despite all the challenges and events that has happened during the first quarter of 2011, when you think of the earthquakes in Japan, the Middle East crisis, as well as the sovereign debt crisis in Europe, we still managed to make a very attractive return for our investors. And if you then put on top our sector exposure to energy with an oil price above 100, which makes our assets more valuable, and as well as our exposure to financials, where the banks are actually doing what we like most, making the banks more robust. And on top of that, we also have a very attractive yield of 9.5%, which all in all makes us very positive the coming quarters.